Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with someone that I've known for a few years, Justin Turner of Traction Capital. I've had Justin on Acquiring Minds a couple times, where we heard his origin story and about the acquisition of a business that today we hear about their exit from. Justin and Traction had a phenomenal outcome on that, and we hear some of the lessons learned. Max, was there anything about our conversation with Justin that particularly struck you?
There was, and congratulations to Justin and his team on that awesome exit. It's amazing, super impressive. So one of the insights that came out of the episode related to diligence, which always gets my attention, as I've said before. And it's not financial, and it has nothing to do with numbers. It has everything to do with diligence on the seller and diligence on the owner, and particularly if a sponsor's investing in a business where the owner might be the CEO and might be rolling equity, as is the case in so many of these deals. I mean, it's super important to determine where the owner's energy is and where it's headed, sort of post-closing. And so Justin mentions that in the best deals that he and Traction have done, the owner's energy quickly moved away from deal terms and EBITDA and multiples and cash at closing to strategy. And in those conversations, Traction was included in these strategy discussions, and the conversations were quickly becoming about growing the business and where things could go and the upside potential. And that's really a tell from a diligence standpoint right away, that you have an owner that's motivated to sell and stay on and grow, and you have an owner that's looking for a strategic partner and not just some cash and to take chips off the table. So, he also mentions a counterpoint to that, where he's had owner conversations strictly focused around the deal itself and deal terms. And he specifically said that those deals did not perform as well. And I think this is just such a valuable piece of information. And it was well thought out and well discussed by Justin.
Yeah, that was really stayed with me as well. A great observation by the team at Traction about performance there. I liked the segment on franchising. So Justin and Traction acquired a business in the restoration and remediation industry, a franchisee. And that has gone very well. That business has grown very nicely. Great industry to be in. There's increasing private equity interest in restoration. We're actually in a deal that's consolidating restoration players. But it's a franchise business. It's a franchisee. And because of the growth, they are now the largest franchisee in the entire network. So the whole franchise system, their unit or territory is the largest. And so Justin talks about the interesting dynamics at play when that happens. And he also kind of reflects on being in a system that has more or less private equity activity. I think that they're essentially the only PE player in that system, and what that means and how that shapes their thinking about if they were to get into a franchise network again, what that would look like.
I thought that was interesting too, the discussion on franchises. And I think if you go back 10, 15 years in time, as we discuss, there was kind of this recognition that private equity didn't like franchisees, that there wouldn't really be a good exit market for these kind of businesses. But Justin appears to suggest that today, that dynamic has changed. There are buyers for franchisees, both in network, but also importantly out of network. And while valuations are still 20 to 30% lower than they would be for standalone businesses, there are also some upsides. And in general, the dynamic has evolved in a favorable way if you own a franchisee. And so I thought that was quite insightful, and that's become kind of a market within the small business space that didn't used to be accessible, not so much because you couldn't buy, but mostly because you couldn't sell, that it has been unlocked a little bit.
On the acquiring minds side, there's also new interest by searchers or increasing interest by searchers, usually acquisition-minded searchers. All searchers are acquisition-minded, but programmatic acquisition interested searchers, because that's where, of course, franchises really shine. The whole integration piece is so incredibly streamlined, you hope, in theory, in a franchise system, because many of the franchisees are going to be on many of the same systems, have all the same SOPs and playbooks that you can, and you have a whole CRM full of all of your acquisition targets. So if you're interested in buying multiple businesses, it's a really powerful way to go, and there are just an increasing amount of case studies doing just that, and larger private equity as well. So lots to like about it. So it always intrigues me to talk about franchising.
I'm putting on my investor hat from Minds Capital's perspective. I think your concerns are about growth and upside and exit opportunities, but from a risk perspective, buying a business that is part of a system, it is less risky than buying standalone businesses because you do have that support. So that is definitely a nice feature.
I think you have more support. I think you also have more diligence to do on the franchisor, because you do get into these situations where, like a Papa John's situation, which I think has been since rectified, where the founder or somebody does something publicly and it affects the whole franchise. I think it could cut both ways in that regard.
Agreed.
Exactly. Great. Well, before we get to our interview with Justin, a reminder: Minds Capital invests equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment. We average a commitment a month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us via our website, mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form on our website for accredited investors. So if you are an accredited investor, you can fill that form out to be kept in the loop on our future raises. Again, mindscapital.co. Here is the Minds Capital podcast interview with Justin Turner of Traction Capital. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Justin Turner is the managing partner at Traction Capital, a Seattle-based investment firm with 5 platforms in its portfolio across consumer, paving and asphalt, and restoration. Justin and the Traction team just exited a 6th investment for a fantastic result. We're going to hear about it. I've known Justin for a few years. He's been on Acquiring Minds a couple times. We're going to link to those episodes for anyone interested in learning more about the origin of Traction. Justin, great to see you again, sir. Welcome to the Minds Capital podcast.
Great to see you as well. Thanks for having me on again. I appreciate it.
Well, to start us off, Justin, help me fill in the gaps there of that description of Traction. Can you share total revenue, employee numbers from across the portfolio, and anything else to give people a sense?
Yeah, absolutely. The numbers have moved around a little bit. As you mentioned, we exited one of our businesses. But for the rest of the businesses that we've partnered with, we finished up 2025 with about 70 million in revenue across the businesses and about 200 employees or so. We've been around since 2018. We've done, I think, 13 deals in total. But yeah, no, I think that was a great description of where we are and what we're doing.
And you as a team are a foursome and always were, right? You founded Traction, the four founders?
Yeah, so there's 4 of us that are partners now, and there was 4 of us that started it. We've swapped one of those people. There was an initial partner that we bought out pretty early on, and then Peter Bell, that's been with us since the beginning, became a partner with us this last year as well. So now he owns part of the Traction kind of parent company also. And then we've got two other folks that are on the team helping, with the businesses as well.
Well, we're going to hear about some of these specific businesses and get into more detail. But let's talk about the business that is no longer part of Traction, your recent exit, C Western. Give us the bullet points there, and then we'll get into it some.
Yeah, that was the first investment that we made at Traction. We bought the initial business in October of 2018, and it was a specialty distribution business focused on supplying equipment to fire departments. And the initial business was primarily Washington and Oregon focused, so working with all the major metros, Seattle, Portland, but also the kind of the smaller rural departments across those states as well. The business has been around since the 70s. It was about 15 million in revenue when we bought the business in 2018, and we finished up 2025 with that business, a little under 100 million in revenue, kind of across we did a number of add-ons, but it kind of across the fire portfolio is about 100 million in revenue.
Fantastic. Can you share how the investment performed? I mean, we can tell by the revenue numbers, but around MOIC or IRR, can you share that?
Yeah, it was a little over 11 times MOIC for our investors. IRR over the 7 years would have been about 44% or so. So awesome outcome for Traction and our investment group, and not necessarily kind of what we were planning on going into the business by any means. But I think there was, just a number of changes in the industry that kind of ultimately led to the decision that it was the right time to, let somebody else be the owner of the business going forwards.
And when you say not what you intended or planned on, that means that it was an indefinite kind of permanent hold. In fact, Traction has that philosophy, doesn't it?
Yeah, I think, and right or wrong, our going into all of the businesses that we've acquired, the goal on the front end has not been, hey, what does the ultimate sale of this business look like? It's been much more about, do we think we can own and grow this business for 10 to 20 years? And what do we think that looks like? And you can really only plan the first little bit of the business and what you're going to do with it. But for all of our businesses, the goal has been, hey, we want to own these for the long term. And I think, as we've gotten, more businesses in the portfolio, we think some of the businesses we own probably lend themselves better to that than others. But with C Western, the goal was certainly not, hey, we think there's going to be a lot more private equity interest in this space. We think multiples are going to expand. And if we do, X, Y, and Z, we'll be in a great place in, 7 years to sell the business. That certainly wasn't our thought process. It was interesting, looking back at our, probably similar to you guys, we put together kind of an initial package that we sent out to investors, and it has a growth section that outlines kind of what we think we're going to try and do with the business. And for us with C Western, the initial package was geographic expansion, product line expansion, and then, M&A if there was opportunities that popped up. And as we think about, how the business went from 15 million to close to 100 million in revenue, it was ultimately those three buckets. We grew a lot organically through geographic expansion, which was the result of having, great relationships with the OEMs of the products that we distributed and kind of getting invited into new territories. We made 4 acquisitions, 4 add-on acquisitions. 3 of those were really kind of product line focused. So we did an acquisition that got us into the compressor market. So the compressors are used to fill up all the air packs that the firemen, wear into a fire. We did an acquisition to get into the rescue tool side of things, which is, think like if you've heard the term jaws of life. We acquired a distributor to give us access to that line of products. And then we bought a business that was a fire truck distribution business. So to get us into that line of work as well. And then we did one that was kind of purely geographic expansion. We bought a business in Utah to really kind of strengthen our toehold in that state.
Do you have a sense of the breakdown of your growth from 15 to 100 million revenue of the split between organic and inorganic?
Yeah. So total acquired revenue, the initial business was 15. We probably bought a total of, call it 30-ish million of revenue. If you include the initial business plus the add-ons that we did. So of that 100 million, probably 70 million of it was organic growth.
Wow. Fantastic. Well, inorganic growth, organic growth, consolidator, private equity interest coming in without anybody expecting it. Yeah, it sounds like a recipe for an 11x.
Yeah,
Does it? So your point about buying businesses with a long-term view, has this experience changed that? Will you buy things with a more traditional buy, build, sell mentality maybe now, or not really? This was just kind of a one-off happy, found yourself in a happy place.
I think, and there's folks that are a lot smarter than us that have, realized a lot of these things. And that's kind of the private equity playbook, at least for a lot of them, is, how do you do the roll-up strategy? I think for us, it's opened our eyes quite a bit on, how do we be more strategic on that growth side, even if it's ultimately a business we think we're going to own for the long term. How do we apply that same lens to really drive the growth? Because whether we're going to own it ourselves for 20 years or we're going to own it for a period of time and then transition it, we should have that kind of aggressive growth mindset piece of it. I think there's definitely been a handful of deals that we've spent a lot of time on kind of over the last 6 months where it's been on the front end much more about, okay, what does the roll up look like, in this space? Do we think there's the necessary fragmentation? Do we think there's, ultimately enough small businesses that make sense strategically, but that build a stronger business, whether it's for us to continue to own or, potentially for either a strategic or a private equity group to come in and want to buy that business from us as well. So I think for us, the M&A side of things will be a big part of growth, whether it's a business we own for a long time or a business that we kind of clearly from the outset think it's one that we're only going to be an owner of for 5 to 10 years.
One of the things you'd mentioned to us is how on this kind of new lens, also thinking about who the buyer might be. So at least having in mind a category, or maybe even more specifically names of potential buyers. Again, not unfamiliar in private equity land to go through that exercise, but it sounds like it's a new kind of new for traction.
Yeah, that typically wasn't a part of our, investment process as we're going through diligence. Part of that was never like, hey, who do we think the buyer of this business is ultimately? It was much more about proving out the industry, the existing business, and then, hey, do we think that there's going to be more of a demand for this product or service in the future? And do we think that we can be the ones to help the business kind of go after that? But increasingly, as we're looking at deals, it's, okay, who are the really large funds, the true private equity groups that are, starting to make investments in this space? And, do we think that they would be, if we're able to be successful with our strategy with a business, do we think that they would be, potentially a buyer of it 5 to 10 years from now? And it's amazing, every industry that you look at, there's somebody that's doing a roll up. in that space. I mean, the one that's not to get sidetracked, but the paving and infrastructure side of things is the one to me right now that I struggle with the roll-ups that are happening in that space. But people are buying a bunch of businesses for 4 to 5 times and then aggregating enough EBITDA and selling it for 10. So
when you say you struggle having a business in your portfolio that's in paving, what do you mean you struggle?
When you think about private equity backed businesses that are having the roll up as the strategy, you're thinking of businesses that have some component of reoccurring revenue. You're thinking of businesses that have a real clear, like, hey, this is how we scale them, versus how we view our paving and infrastructure is, we from the outset were like, hey, these are construction businesses, these are project-based businesses. We're going to have to go out and win jobs every year for these businesses to continue to be successful. And for us, it was much more about, hey, like here in the Northwest, we know that infrastructure investments are going to be a big part of just the regional economy because of the growth that's happening, because of the quality of our infrastructure. And so for us, it was much more about like, yes, it's project based. Hopefully we're getting a little bit better price on the front end for it, but it's a line of work that's not going to go away. And so if we can continue to deliver quality, we can continue to have the relationships that we have, hopefully those businesses continue to grow a little bit over time. And then you look at, some of the roll-ups that are happening that are trying to pitch it as a reoccurring revenue, albeit, maybe it's every 10 years that revenue is reoccurring if you have to redo a parking lot or whatever it may be. But it's just a very different business, I think, than private equity would have gone after 5 or 10 years ago.
And you guys yourselves have found it to be different, even though your thesis about it was different than private equities. It's still been a hard one, even going in with eyes wide open.
For sure. I think there's a reason that when you're looking at, the search fund, like, hey, these are the characteristics of a business you should buy. There's a reason that construction and project is not on that list. And I think for us, we think leadership is unbelievably important for all these small businesses. That person is setting the pace, that person is setting the culture. And I think it's even more so for kind of your construction and project-based businesses, because they're tough businesses to be an employee of at times. Like, the work is hard, the hours are long, you're out in the elements, your body's going to hurt. It's not necessarily the most enjoyable work. And so, that piece of it has been a challenge for us. And I think we've tried to do a good job of building out the management teams. And we just had all the management teams for our portfolio companies in here at the beginning of this week for kind of annual meetings. And it's been fun to see just how that room has changed over the last couple of years, and the folks that we have, in really key leadership positions in the infrastructure group now, that, I think we kind of went through the valley with them. And now I think we've got the team in place to help us kind of come out the other side. But yeah, that leadership piece is super key. And with the project-based businesses, your CEO is going to have, in most cases, really tight relationships with your customer base that, could potentially walk out the door if that person decides that, they're not happy with having a partner now in the business, or they're tired of working every day. And so there's a risk associated with that. And so figuring out how you transition those relationships to try and be relationships that the business has versus that an individual has, I think is a somewhat unique dynamic on the construction side of things.
I think a paving business, like you point out, similar to a construction business, is one of those I would categorize as a great business to own, especially if you're in a growing market like the PNW. But if you put your investor hat on, right, is this something you want to buy top dollar with high leverage? And that's where it becomes more of a dubious bet. And so
Have you been listening in on our internal conversations?
no, but I think it ties back to what you said, that you are a prospective long-term holder. Because if you have a 5-year time frame, you just don't know what will happen in 5 years in a project-based, person-dependent business. But over 20 years, it's pretty easy to be optimistic about the Pacific Northwest and generally being in the infrastructure space. And so I think there's a nice link there for you guys if I was to assess it from the outside. Now,
For sure.
jumping back a little bit to your recent exit, you said that you had acquired 30 million of revenue. You exited and the platform had 100 million. So that means that you more than 3x'd revenue through organic means. You mentioned that you had done so through doing, and you made it sound almost simple. You said, oh, we did geographic expansion, we did product expansion, and we did some M&A. But, as I was thinking about this, it sounds easy when you say there are only 3 things, but what are the other factors? What could be other growth drivers? Because when you think about it, that's actually quite an exhaustive list. I suppose pricing could be a 4th one, but can you elaborate a little bit more anyway on the growth journey that you had? Because 3xing any business, let alone a distribution business to municipalities, seems like a really strong execution.
Yeah, I think we were, not to keep harping on leadership is important in these businesses, but I think we were really fortunate. We partnered with an awesome CEO in that business, that his dad was the founder of the business. We bought the business from him and his sister. And so I think we were fortunate, when we talk about setting the pace, when we talk about the culture, Steve is ingrained in that industry and has a growth mindset, like wants to go out and figure out, how do we do a better job for customers? How do we serve more customers? And I think where we in the early stages kind of set the foundation for the growth is, similar to other stories you hear about these small businesses, the system and admin side of the business was, really piles of paper that moved literally through the office to go from sales to orders to customer service to invoicing. And so, a couple folks on our team spent a lot of time the first, 18 months, 2 years, actually putting in systems. So we went from a paper-based system to NetSuite. We built out some tools so the sales reps could quote in real time with the customer on the products that they were looking for, with kind of built-in pricing parameters, so that if the sales rep needed to move margin a little bit to try and land a sale, they could do a certain amount of that without having to go back to the head office, without having to have a meeting and say, hey, we're trying to get 23% gross margin. This customer wants, or to win this, project, we're going to need to be at 20% gross margin. Can we do that? We built in some wiggle room for the sales reps. And then, so the true like systems process side of it, we spent a lot of work on, but then, we also made the decision to, hey, we're going to invest in the team, and we're going to build out a team that can actually run this business and not have it be just kind of the CEO with a bunch of sales reps. But we had a 5-person management team when we exited the business, and that was not, the case when we bought it. And so it was kind of gradually finding the right people that can run territories, manage teams, so that the CEO can be out saying, hey, what are the next geographies we need to go after? Is that organic? Is it, we need to find an acquisition to do there? What are the products we want to add? And, how are we getting in front of those OEMs to set the table that maybe not immediately, but maybe a year from now, we're going to be able to start distributing that product in the geographies that we, work with customers in. And so there was a ton of the kind of blocking and tackling work, systems, people that allowed us to, go out and experience the growth that we did. The business historically had tried to, work with the top 1 or 2 products in a category. And so, we could have probably done some of the things a little bit quicker, but to get the right products for us, it took a little bit longer in some of the cases. But yeah, just an awesome job by the team there. They killed it.
Would you say there are any catalysts that we're missing here? Because you're talking about a strong team and you're talking about blocking and tackling, but the vast majority of PE owners will say that they have a great team and are good at blocking and tackling. So what truly is there anything that set this apart, that really helped you outperform peers? Because again, 3xing revenue in such a short time frame organically is really well done.
Yeah, I mean it sounds simple to say, but I think we one, like, we applied maybe the private equity playbook at a much smaller scale. So I think there's probably not as many folks that are, doing those things at subscale businesses, and we started doing that early on. Like, the business at 2 million in EBITDA probably didn't need NetSuite, but we knew that if we executed on where we were going, like, $100 million business probably does need something like NetSuite. And then we really tried to differentiate ourselves from how we took care of the customer. A lot of the folks that we compete with, it's, the sales rep shows up when the customer's ready to buy something and doesn't have that more, what I'll call, like, relationship driven sales side of it, to where our sales reps are kind of continually out meeting with the departments in their territory and not just saying, hey, let us know when you need to buy something. And so that kind of focus on the customer side, when we were talking to the OEMs, they'd be coming back to us saying, hey, we want that. This distributor in this region is not doing that. We're going to move you guys into that region to provide competition. And so a lot of it was how we took care of customers that enabled us to be able to expand geographically, because it's not like there was nobody selling in Colorado. It's just we were able to do it better. It's not like there was nobody selling in California. Our approach to how we took care of the customers was different from a lot of the folks in the industry. And I think that enabled us to experience some of the growth from the OEMs, almost pulling us into kind of new territories.
You obviously built a much bigger business here, but you also emphasize how you built a better business by building out the team and also using NetSuite. And when you go to market in an exit, right, you go and interview bankers, and the bankers, as I'm sure you're familiar, they will say, we think you will be able to get 8 to 10x. I don't know what kind of exit multiple range you guys were in, but they'll give you a range. And what I would like to explore with you here, based on your very recent experiences, what are the factors that enable you to get 10x versus 8x within that range? And if you reflect on your exit, what were the factors that helped pull you up? And what were the factors that perhaps, if you had squeezed things, you could have gotten an even better multiple if you had kept working at it?
Yeah, it's interesting. I mean, not to go off topic, we just put an offer in on a deal here a month and a half ago, for a business that was sub 3 million in EBITDA. And the only folks invited to management meetings were folks that were 9x or above. So I think some of it is, industry dynamics. Is it an appealing industry? Is there, aggressive private equity involvement in that industry that they're trying to aggregate EBITDA? I think for us, you're talking about distribution with the fire equipment business, you're talking about distribution business. So you're not talking about a business that's generating, 20% EBITDA. You're talking about a business that's high single digits, low single digits EBITDA. And I think the things that really helped push that multiple up, because we ended up selling for kind of above. I mean, we interviewed a bunch of investment banks going into this process, and we ended up selling kind of above almost everybody's target in their pitch. And we said the folks that we landed with, we sold above their target from their pitch to us. And so I think industry dynamic is a big one. Is there larger players that are either have an investment in the space that view you as very strategic? Is there folks that have a thesis around what you're doing that are not yet into it, that need to find a platform, and so they maybe need to try and overpay a little bit? And And then, at a certain point, scale kind of gets you there as well. So, as you move up in EBITDA, in theory, your multiples are going to expand as well. For us, we had started to get some scale. And for the ultimate buyer of the business, we were a thorn in their side, and we were very strategically important for kind of what they were trying to do with their business.
A thorn in their side, meaning a competitor?
A competitor. And, talk about the tension of how customers are taken care of. We were being invited into a lot of their territories. So yeah, we were very key for them, for what they're trying to do with their business as well.
Earlier, you said that it was the right time for another owner for this company. Well, what do you mean by that? Well, what is the right time to change ownership?
Yeah, I think it can vary, depending on the group. I think for us, being an independent sponsor, we raise, deal by deal. And, we raised a certain amount of money to get the deal closed. And for kind of the next, and we were able to do, all our add-ons and everything, either refinancing the senior debt or using cash off the balance sheet to get those acquisitions done. I think for the next phase of growth, if we were going to stay independent, it was going to be a lot larger acquisitions to kind of get into, to move further east. If you think about population density of the US, East Coast, a lot higher population density. So the fire department side of things there's just a much bigger market there. And there's a lot of businesses that have been in that area for a long time. And so for us to continue growing east, it was going to require kind of lumpier, larger acquisitions that we were going to need to raise a lot of capital for. And we felt like it was probably time for a different person ultimately to be the owner of the business, to go after that. I think it's the good and the bad of the independent sponsor model. You can be really capital efficient, but at a certain point, at least for us with how we've done it, like we probably get the businesses to a certain size where we're either going to have to take on a minority investment or, sell the whole thing, depending on the cash flow dynamics of the business.
Justin, you still have the business in the portfolio, so maybe it's not a success in the sense of an exit, but it sure looks like it's going very well. Your restoration business, there's some interesting elements to that business. Let's hear the main bullet points about kind of the growth there, and then we'll get into it in some more detail.
Yeah. So we have a business called Restoration One. It's a franchise. So we're a franchisee in a system. The business is headquartered in Spokane, Washington. We bought it in January of 2023. It was about 10 million in revenue, or so when we bought it. And the business, if you've ever had a pipe burst or you've had water damage or mold or fire, this is a business that would come in and help kind of get your home back to being your home again.
And it has grown a lot. And this is an industry where I don't think you did it here either, but you find yourself in an industry where the private equity activity is heating up, right?
Yeah, we, again, like at the outset, it wasn't us saying, hey, like there's all this private equity interest in restoration. But that certainly has been the case kind of since we've been in the industry, and even before some of these rollups were already starting. But you're talking about a business that when you need that service, you're not getting quotes, you're not scheduling it out. It's, hey, how fast can you solve this problem that I have? And the business has grown a ton. And I think similar to the fire business, we partnered with a amazing CEO who is very growth focused, who is very kind of team and system focused. But for him, he wanted someone else in the room to help kind of bear the weight of business ownership. He didn't want to be the one having all the decisions on his shoulders. He didn't want to be the only one, laying in bed at night thinking about the business. And so our role there, initially was really just to be an ear for him. So he still owns a big chunk of the business alongside of us. But I think we've been able to be a good partner for him to help him think through the growth side of things. So that business, it was about 10 million in revenue when we bought it. We did about 25 million in revenue in 2025 with that business. We think next year it'll be somewhere kind of mid 30s.
Wow.
And it's, you mentioned the industry is a hot one right now. I think being inside the franchise system, changes that dynamic a little bit. But on the flip side, there's also a lot of, franchisee businesses that are trading at very attractive multiples as well. But, similar to all our other ones, like we didn't go into this thinking, hey, how do we get to, 5 or 10 million in EBITDA and then have an exit with this business? It was more about, well, we don't think that these types of events, whether they're weather driven or not, are going to slow down. We think that aging housing infrastructure, there's going to continue to be issues with pipes and leaking and mold. And so there's going to be a kind of continual pipeline of work for these types of businesses. But the market has gotten a lot more competitive. There's a lot of folks that are seeing, the industry headlines that you're mentioning and saying, oh, I can figure out how to do that. And it's been a good, learning experience for us on the franchise side of things as well. That's a very different dynamic than, being an independent in any industry.
Well, let's get into that a little bit, starting with just the what it does to price, understanding that you guys weren't looking to exit on some sort of timeline. But regardless, it does depress a little bit enterprise value. On the other hand, your entry price was probably also got a discount versus had it been an independent business. So it may just be a wash. Respond to that, and then let's get into being you got to be one of the most successful franchisees in the system at approaching $30 million in revenue.
Yeah, I think to your kind of initial question, I think there certainly is a discount, associated with being inside of a network. If you're an external buyer looking at a franchise business, you're going to say, hey, well, my growth is going to be capped at some point because, there could be a business for sale that's not in the system that I can't then go buy, which is true. But there's also a lot of built-in growth, inside of a franchise network as well. Whether that's greenfielding new territories or, in our case, kind of becoming the buyer of choice as there's other franchisees that either raise their hand and say they want to exit, or as there's franchisees that the franchisor is saying, hey, you need to no longer be in our system. We think you should sell the business to someone, and we can become kind of the buyer of choice for some of those things as well. And, I think we certainly got a discount compared to, an independent. And, we're not looking to sell that business, but, we have banks reach out to us all the time because it is a hot space. And so we do, talk to them about what they're seeing from a multiple standpoint. And, some of the banks focus on selling franchisee businesses. And our guess is it's probably a 20 to 30% discount that you're taking. But when the independents are selling for, low teens multiples, like that probably still means that if you go to sell, like you're still probably getting high single digits, low double digits. But yeah, it's been really interesting, just the franchise dynamics. We are the largest franchisee in the system by a lot. And that can be good and bad. They kind of leave us alone to go do what we need to do. And I think, some of the things that we develop internally, end up being a help to other franchisees as well. But I also think depending on the franchise system that you're in, they're not always set up to help the largest franchisee. I think a lot of franchisors are geared towards how do we help the businesses get to some scale, not how do we help the largest person in the room, continue to grow at 20% a year. So there's just some challenges there.
And which is to say that, of course, the fees you're paying, at some point, you may outgrow the value that those fees are meant to send back to the franchisee because you're bigger and more sophisticated, maybe than the franchisees, than the typical franchisee that those fees are intended to help.
Yeah, I mean, I think, again, we bought into a system that was smaller to begin with. And so, hindsight's 2020 on what you're negotiating when it's the first time negotiating franchise agreements. But, I think we've seen some other systems where there's kind of a graduated fee schedule. As you scale, kind of certain things change. That's not the case in our system, right now. So there certainly is heartburn at times as you're, sending $1.5 million that's kind of a hit to your P&L right off the top. So we talk to folks about that and they're like, wait, so you're upset that you've been successful with the business?
Yeah.
It's like, well, okay, good point. Good point. That's fair.
No, but I imagine the dynamics with the franchisor are pretty interesting on this point about fees. But also their view of you, which is great to have the sophisticated operator in the network that can develop some best practices and spread those around the network, and the entire network benefits and improves based on that. But at some point also, maybe there's a sense they don't want you to get too big, too much of a voice, because it is, after all, a divide and conquer, maybe from the franchisor's perspective. So you could imagine that it's a really interesting tension there. And as you get bigger and bigger and bigger, maybe they start to get uncomfortable for a variety of reasons. So what would be the lesson there for you or for the listener who might be contemplating an acquisition in a franchise network? Is there any kind of generalization you could make?
I think we would be open to doing a franchise again. Like overall, it's been a positive experience for us. The business has done really well. I think, if we were going to do it again, we would probably look for a situation where we weren't the first kind of private equity investor in the system. And I think we'd spend a lot more time thinking through, okay, if we execute on the growth and we're really successful, what percentage of the system do we get to? And do we think that that's at a level where it becomes an issue for us or that it becomes an issue for the franchisor? Because I think, it hasn't necessarily been an issue for us yet, but, in the event that the franchisor was going to go through a sale process, like anytime you're buying or selling, like concentrations, whether in whatever form they are, come into play, and having concentrations when you're selling, whether it's a franchisor or a franchisee, that can just raise a lot of questions and present a little bit of a challenge, kind of no matter what side you're on.
Yeah. Yeah.
Do you think your willingness to do a franchise reflects the broader private equity industry? If you were to compare today versus 15 years ago, how tolerant do you think private equity is to franchise acquisitions? And as part of why you're willing to buy one, that you feel reasonably confident you can also exit one where that may not have been the case 20 years ago? What are your thoughts on that?
I think increasingly, private equity is getting comfortable being a franchisee in a system. I think you see it in, the Neighborly group of home services franchises, there's a ton of private equity exposure at the franchisee level. You talk to folks like the Boxwood Partners guys, they're doing a ton of franchisee M&A to private equity groups. And I think, you look outside of home services, I think that the concept of franchise businesses has been around a lot longer. If you look at fast food, fast casual, if you look at the fitness industry, there's a lot of private equity groups that have become large franchisees in some of those other systems. So I think there certainly is, more of a familiarity. There certainly is more of an interest. And I think depending on the system and the size of the system, I think it can be a great business for private equity to be in. You think about on the fast food side of things, there's almost no limit to the M&A you can do once you're inside a fast food system. There's thousands of locations that all look and operate exactly the same. So you can build a lot of scale there for sure.
Yeah. I mean, the opportunity for programmatic acquisition, it couldn't be juicier. I mean, the integration is essentially pre-baked. Everybody's on the same systems, same processes. Sure. I may be overstating a little bit, but in theory, you can just populate your CRM from day one with all the targets that you want to reach out to. I mean, it really is a lot of the hard work of M&A and integration is pre-baked within a network.
Yeah. And I think if you look at some of the larger home service, like on the restoration side, you look at like the Service Master and Serve Pros of the world, there's getting to be private equity groups buying franchisees that are north of 10 million in EBITDA for that reason. They're saying, hey, this is a fragmented market. Granted, it's fragmented inside of the franchise system, but there's, to your point, built-in M&A pipeline of businesses that we know are operating very, very similar to the one that we already have.
Yeah. Well, you're also seeing this on the searcher side, by the way.
Yeah. Interesting.
Yeah. For the same reasons. Many
Yep.
searchers kind of get into search thinking that they wouldn't want to do a franchise. In fact, search ETA in some sense is the alternative to franchising because they're kind of both ways of getting into entrepreneurship without doing 0 to 1. And they've kind of gotten into search dismissing franchising. But then they learn that actually search and franchising go together beautifully for all the reasons that we're talking about. And that can open their eyes. And there's some really great case studies and guests I've had who've done that playbook. So, Justin, we only have you for a couple more minutes. I wanted to circle back to close us out just on more thoughts around CEOs and leadership. You had said to us that your best investments basically correlate with strong leadership, strong CEOs. Maybe that's the punchline, but if you would try to expand on that and what you've learned there and what people can learn from Traction's experience.
Yeah. And I think there's a lot of folks smarter than us that probably would have figured this out a little quicker than we have. But, as we look again, hindsight's 2020, as we look back on, the deals we've done, the deal processes, the businesses that we've acquired, and we talked about this last week, but the nature, I think for us, we've seen that the nature of those conversations kind of leading up to close have been highly correlated with the outcomes kind of post-close for us with those businesses. And for us, where we've seen that is, if you're going into a deal and you're under LOI and, for us, like I'm talking to those CEOs all the time during that diligence process leading up to close. And what we've seen is that, if those conversations are 99% about the deal and working through deal points, talking through issues on the transaction, and that there's no or little discussion around, hey, here's kind of what we're working on in the business. Here's what we're thinking about. Here's what I'm having my team do. That the lack of those conversations leads to poor performance post-close. But we can look back and say, okay, for like a restoration deal, great example. We talked a lot about the deal, but we probably talked equally about, hey, this is what I'm thinking for a growth strategy, or I'm thinking about changing this thing with the team. What do you guys think? And so if you're getting brought into, I don't want to say the strategic conversations, but if you're talking about the business itself and how to improve that pre-close, I think that's going to lead to a much better outcome kind of post-close with the business. And we've seen
the idea
that
here is it's a tell that
Yeah.
your CEO owner is invested in the future versus
For
just
sure.
trying to consummate a deal and have their liquidity event.
For sure. For sure. And so for us, like we like to have kind of prior owner involvement. You know, we've bought some businesses where there was a clear timeline on that from the beginning. And that's, you know, I think a different conversation because you're already planning on that person transitioning out of the business. But for the ones where the goal has been long-term involvement from that prior owner, those kind of pre-close conversations have been wildly accurate in how the business has performed post-close.
And what about whether or not it's a business where the owner wants to continue on? That was the case in Restoration. Was it the case in C Western in the distribution business where that they carried on as the owner, as the CEO?
Yeah, so we it was a brother and sister that we bought it from in the C Western case. Their dad started the business. They rolled over some equity, and then the brother kind of stayed on initially kind of in the head of sales role, and then pretty quickly we were like, hey, we think you should have the CEO role. But from the outset with that, our goal was to have him involved longer term, and he earned some more ownership kind of each year that he was still involved there. And same
So
with
is
the
there some
restoration business.
generalization to be made there that you'll look for opportunities where the current owner will carry on as CEO, or it's not such a clean, that's not a clean criteria necessarily?
It's not as clean because I could point to some other ones that it has not been as up and to the right as we would like. So it's not as clean, but I think at a certain level, you know, the owner saying, I do believe in this business and I do want to own some of it going forward. I think overall, we think that is a positive. There's other folks that would say, you know, absolutely not. We think that's, you know, a huge negative, but not necessarily a huge negative, but we just won't entertain that. But for us, we're certainly open to it, and we love, you know, partnering with existing teams.
You said that you had just had your annual meeting of all of your portfolio CEOs. What does that look like? How many are there? Is it only the CEOs or the entire executive team? Is it a 2-day or 1-day event? What does the agenda look like? What are you all getting out of it? Can you tell us a little bit more about this?
Yeah, we're trying to be better. You know, I would say as a firm at Traction, like part of us is still a startup business. Like even though we're, you know, 7 years in, part of us is still trying to figure out, you know, what does the cadence for things like that look like? But for this, we had everybody come in. We wanted to have everybody in for a dinner, you know, at least one of the times to get everybody together. But then for the individual businesses, it was kind of 3 to 4 hour sessions of, you know, talking about 2025, but then thinking through like, hey, what's our goals for 26? But then also what are the kind of the initiatives and issues that we need to solve for to allow us to kind of hit what our goals are for 2026. And then, you know, the goal with the dinner is we want, you know, the leaders in the businesses to just get to meet some of their peers, and they may not all be in the same industry, but you know, they're dealing with a lot of the same challenges, whether it's, you know, people or systems or, you know, how do I manage, you know, this type of issue? How do I think about sales and marketing? And so I think it was a really good, you know, just event for all the CEOs to get together. And we had kind of the top 2 or 3 folks at the businesses come out for it. So we've done the annual planning in different kind of variations in the past. But going forward, we'll have probably 1 or 2 times a year where we try and get the leadership teams all together in person to either do an activity or share a meal and just kind of get to learn hopefully from each other and develop relationships that can be valuable kind of going forward for them, as well as issues or opportunities pop up with the businesses that they're kind of helping to run.
Well, Justin, thank you for coming on the Minds Capital podcast. Great to be on the other side of the mic from you for a third time, different podcast. Congratulations on the C Western exit, even though you didn't intend for it to happen. Great when it works out that way. We'll link to your past appearances on Acquiring Minds, to Traction, and to your LinkedIn in the show notes. Justin Turner, thanks very much for joining us.
Thank you, guys. Thanks for having me on. Appreciate it.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.